good morning, good afternoon, good evening. Wherever you are in the world, thank you for joining me. Today I want to take you on a journey, not just a journey of a company or a stock, but a journey of transformation. Because what we're talking about today is much bigger than a ticker symbol. We're talking about the future. Imagine waking up one morning and realizing that the foundation you trusted, the one you believed was unshakable, is shifting beneath your feet. That's what happens when the world's monetary system begins to change. Quietly, slowly, then all at once. For decades we've been taught to think in one currency, to measure wealth and progress through a single lens. But that assumption is starting to crack. The system built on a single monetary anchor is now facing its greatest test in decades, and those who see the signals early will be the ones to adapt, thrive, and lead through the change. What's happening today is not just about economics. It's about the redefinition of trust, who issues it, who controls it, and how it flows across borders. When a currency begins to lose its purchasing power, it doesn't happen overnight. It happens through small, seemingly invisible erosions. Policies shift, debt expands, confidence weakens, and before we know it, the global economy begins searching for alternatives. That's where innovation and diversification intersect. We are entering an era where monetary dominance will no longer come from one country, one system, or one policy decision. It will emerge from technology, transparency, and decentralization. Think about how the world once revolved around a single source of energy, oil, until technology unlocked new options. The same evolution is beginning in money. Digital assets, decentralized platforms, and borderless payments are introducing competition to a system that hasn't faced it in generations. And with competition comes accountability. Now, this isn't a call to abandon traditional currencies. It's a call to understand that the world is evolving beyond them. Throughout history, the greatest shifts in value have come not from holding what's comfortable, but from recognizing what's coming next. When we rely on one currency, we tie our financial future to a single set of decisions made by policymakers, central banks, and political cycles. But technology doesn't wait for policy. Innovation doesn't ask for permission. And in that tension lies opportunity. As investors, as builders of the future, we have to recognize that value is becoming more fluid. It's no longer just measured in dollars or euros or yen. It's measured in data, in networks, in intellectual property, in trust that transcends borders. The companies and individuals who understand this shift will not only preserve their wealth, they'll multiply it. Because what's unfolding now is not merely a currency transition, it's a transformation of the entire financial architecture. For decades, global trade and finance depended on one dominant system. That created stability, yes, but it also created fragility. A single point of control is a single point of failure. When that point weakens, everything tied to it trembles. We've seen what happens when liquidity dries up, when inflation accelerates, when debt ceilings and interest rates collide. Those who diversify, across assets, across geographies, across systems, position themselves not just to survive, but to capture what comes after the reset. Innovation has always democratized power. Just as the internet broke the monopoly of information, decentralized finance is breaking the monopoly of money. That's uncomfortable for some, but it's inevitable. The question isn't whether the world will diversify its monetary base, it's how quickly. And when that shift accelerates, it won't reward those who stayed still. It will reward those who understood that relying on one currency is not security. It's concentration risk. The future of wealth will not be about speculation, but about participation, about owning real, productive, adaptable assets, those that can withstand volatility and benefit from technological compounding. The best investors in history weren't those who followed consensus, they were those who saw paradigm shifts before they became obvious. Today, we are living through one of those paradigm shifts. The next decade will not look like the last. The way we store, move, and measure value is being rewritten. Currencies will compete, technologies will collide, and investors will have choices, more than ever before. The ones who win will be those who refuse to be anchored to a single narrative. They will look beyond the noise, beyond the comfort of legacy systems, and embrace a more dynamic, resilient view of money itself. So the call is simple: do not rely on one currency, one country, one system to define your financial destiny. The world is too interconnected, too fast moving, too innovative for that. Think in systems, not symbols. Think in networks, not notes. And remember that every great transformation in history looked uncertain at first, until it became inevitable. The world is on the edge of a financial renaissance. Those who prepare now, with courage and conviction, will look back one day and realize they didn't just protect their wealth. They participated in the reinvention of value. The future of money is unfolding, and the greatest risk is standing still. There's a moment in every cycle when illusion gives way to reality, when the abstract promises of paper wealth collide with the tangible power of real assets. We are approaching that moment again. The world is realizing that owning real things, things you can touch, build, measure, and deploy, is not just a hedge, it's a foundation. For years, financial markets have rewarded leverage, liquidity, and intangibles. But history has a rhythm, and the pendulum always swings back to what's real. When uncertainty rises, when trust in systems wavers, investors rediscover the power of owning something that cannot be printed, replicated, or easily devalued. Real assets, productive land, critical resources, breakthrough technologies, intellectual property with real, world applications. These are the pillars of resilience. The shift isn't just philosophical, it's structural. We've entered an era where scarcity meets innovation. Energy systems are being rebuilt. Supply chains are being redefined. The very infrastructure of the economy is being redesigned for a new world, one driven by automation, electrification, and intelligence. The companies at the center of this change don't merely sell ideas, they produce, they manufacture, they move atoms as well as bits. They are building the backbone of the next economy. Owning real things means owning what endures through volatility. It means holding the kind of value that doesn't evaporate when sentiment shifts. Digital representations of wealth can fluctuate dramatically, but tangible innovation, the kind that creates products, infrastructure, and capabilities, compounds over time. It's the difference between speculation and creation, between trading noise and building the future. Throughout history, the greatest fortunes have been built not by chasing what's fashionable, but by backing what's foundational. Think of the Industrial Revolution: steel, railways, electricity. Each breakthrough started as an investment in something tangible, something misunderstood at the time, something that redefined productivity. Today that cycle is repeating. Only now are real things look like next-generation energy grids, robotics, autonomous systems, artificial intelligence embedded into real-world operations. These are not abstractions, they're new forms of infrastructure. There's also a psychological dimension to this. In times of easy money, it's tempting to believe that owning paper claims is enough, that wealth can simply exist as numbers on a screen. But when inflation accelerates, when capital costs rise, when liquidity tightens, the illusion fades. What holds value then are the assets producing real utility. They generate cash flows, save time, store energy, or power networks. Real assets have gravity. They pull value toward them because they serve a function that can't be replaced by financial engineering. Owning real things isn't about rejecting innovation, it's about grounding it. The most transformative technologies of the coming decades will have physical footprints. They will manufacture, distribute power, and compute. Their value will not rest solely in code or models, but in their ability to change how the physical world works. Innovation is most powerful when it meets production, and that intersection, where digital intelligence meets tangible output, is where the next era of growth is emerging. The irony is that most investors won't see it. They'll stay fixated on quarterly results or price multiples, missing the deeper shift beneath the surface. But those who think in decades rather than months understand that every technological revolution eventually demands tangible anchors. Even software needs servers, data centers, energy systems, and devices. Even AI, for all its abstraction, requires semiconductors, infrastructure, and robotics to make impact real. That's why owning real things matters. because it connects you to the underlying productivity of the economy. In an age of digital illusions, authenticity has value. In a market driven by narratives, substance becomes scarce, and scarcity creates opportunity. The world is entering a rebuilding phase of infrastructure, of energy, of manufacturing, of systems that actually produce. This isn't the end of innovation, it's the materialization of it. Those who own real things, the companies driving production, the technologies with physical utility, the assets generating tangible output, will define the next compounding cycle. When fear rises, the market sells what it doesn't understand. But when clarity returns, it reprices reality. That moment is coming, and those holding real assets, real technologies, real intellectual property will be the ones standing firm as the noise clears. Because in the long run, paper wealth follows real wealth, not the other way around. So when you think about positioning for the future, think about ownership differently. Not as a number, but as a claim on real progress. Think about what's being built, not just what's being traded. Because the next generation of prosperity won't come from chasing abstractions. It will come from anchoring innovation in the real world. The time to own real things is now. Not out of fear, but out of foresight. Not to escape volatility, but to harness it. The world is rebuilding, reindustrializing, reinventing its foundations. Those who align with that reality, who invest in what's tangible, productive, and transformative, will own not just assets, but the architecture of the future itself. There's a reason the most resilient systems in nature and markets share one common principle: diversity. Monocultures might thrive for a season, but they collapse under stress. The same is true for portfolios, economies, and even ideas. Diversification isn't just about spreading risk. It's about ensuring adaptability when the unexpected happens. It's protection not through prediction, but through preparation. The world we're living in now is more interconnected, faster, and more fragile than ever. A single policy change, supply disruption, or geopolitical shock can ripple through markets overnight. In that environment, concentration is not conviction, it's exposure. True conviction means positioning yourself so that no single variable can derail the entire strategy. That's what diversification really is, not dilution of focus, but amplification of resilience. For years, investors have chased what worked last decade, the winners that seemed unstoppable, the narratives that felt permanent. But permanence is an illusion. Every technological revolution has reshuffled leadership. The names that dominated one era often fade in the next. Diversification ensures that when the market's center of gravity shifts, and it always does, you remain balanced enough to capture what's next. Think about the last few decades. Investors who concentrated solely in traditional energy missed the rise of renewables. Those who stayed only in brick and mortar retail missed the e-commerce revolution. Those who ignored software missed the greatest wealth creation in modern history. But those who diversified intelligently across innovation platforms didn't have to predict the winner. They participated in the transformation. That's the essence of protection. It's not hiding from risk, it's positioning across possibility. We're entering a period of accelerated change in energy, in automation, in AI, in healthcare, in finance. These shifts are not isolated, they're converging. Each breakthrough strengthens the others, compounding innovation across sectors. That's why diversification today doesn't just mean owning different stocks or sectors. It means owning different futures, different forms of progress, each built on distinct yet complementary foundations. Protection in this context comes from embracing asymmetry. Some parts of the portfolio will surge ahead when others lag, and that's exactly the point. Diversification gives you optionality, the ability to stay invested in innovation while withstanding the inevitable volatility that comes with it. It's the antidote to fear-based decision-making. When one pillar shakes, the others hold. We've seen time and again what happens when investors forget this principle. When confidence peaks, concentration grows. People convince themselves that one trend, one asset, one sector can carry them through. But concentration is only rewarded in hindsight. It feels brilliant on the way up and catastrophic on the way down. The path to enduring success isn't about guessing the single right answer, it's about ensuring multiple right answers have a place in your framework. Diversification also protects against bias, the kind that narrows our view and blinds us to emerging change. Every investor, no matter how rational, sees the world through a lens shaped by past success. But the future rarely repeats the past. It rhymes, it evolves, it transforms. Diversifying across technologies, geographies, and asset classes allows us to keep our perspective wide, our assumptions tested, and our curiosity alive. This isn't about owning everything. It's about owning enough of what matters, enough exposure to the forces that are reshaping the world, the exponential technologies, the new business models, the infrastructure of tomorrow, enough balance to withstand drawdowns without abandoning conviction, enough flexibility to adapt when the data shifts. The irony is that many people view diversification as a defensive move when in truth it's the opposite. It's what enables offense. When you know you're protected, you can take bold positions, you can lean into disruption, embrace volatility, and hold through turbulence. Protection through diversification gives you the freedom to pursue growth fearlessly. Think about ecosystems. The most robust ones aren't made of uniform species, they're made of interdependent ones. When one weakens, another fills the gap. When conditions change, new strengths emerge. That's what a well-structured portfolio does. It breathes, adapts, evolves. It doesn't crumble when one theme falters, because its strength isn't built on sameness, it's built on diversity. As investors, as builders, as visionaries of the next economy, we have to internalize this truth. The future is uncertain, but that uncertainty is where opportunity lies. Diversification is the bridge between uncertainty and potential. It allows us to stay exposed to innovation without being destroyed by volatility. It allows us to remain confident in conviction while respecting the unknown. Protection doesn't mean retreating to safety, it means staying strong enough to keep advancing. It's how we participate in transformation while surviving its growing pains. In a world defined by constant change, diversification isn't a strategy, it's a mindset. It's the understanding that no single trend, no single asset, no single idea will define the next decade alone. So diversify with intention. Across ideas, across industries, across time. Build a foundation that can bend without breaking, that can absorb shocks and still move forward. Because protection isn't found in standing still, it's found in staying balanced while moving through uncertainty. The strongest portfolios, like the strongest systems, are not those that avoid risk, but those designed to endure it. Every great transformation in history has unfolded in cycles, long, rhythmic waves that most people only recognize after they've already crested. The challenge, and the opportunity, lies in seeing those waves before they break. Thinking long-term is not just about patience, it's about perspective. It's about stepping back far enough to see the patterns that short-term noise hides. Because markets, like nature, move in seasons, each with its purpose, its lessons, and its possibilities. Right now, we're in one of those pivotal transitions that define decades, not quarters. A reset is happening across technology, finance, and society. Many are focused on the daily fluctuations, the volatility, the headlines. But behind it all, something deeper is unfolding. The next long-term growth cycle is being built. Innovation is accelerating again, productivity is being redefined, and capital is being reallocated toward what will shape the next generation. It's easy to be discouraged when markets contract, when valuations compress, when sentiment turns pessimistic. But every major breakthrough, every bull market that redefined industries, began in moments like these. In the short term, uncertainty dominates. In the long term, progress always wins. The investors who understand this don't react to cycles, they anticipate them. They know that volatility is not a verdict, it's an invitation to look further ahead. Throughout history, each economic era has been driven by a core set of technologies that compound together until they reshape everything. Steam, steel, electricity, semiconductors, each of these sparked multi-decade cycles of innovation and growth. What we're seeing today is the early stage of a new one, built on the convergence of artificial intelligence, robotics, energy storage, and genomics. Each of these technologies is powerful alone, but together they form the foundation of a transformation that will unfold over decades. Thinking long-term means understanding that progress is rarely linear. The path forward is full of pauses, corrections, and moments of disbelief. That's not failure, it's how compounding works. Growth accelerates slowly at first, then suddenly. But to capture that exponential curve, you have to endure the flat part of the line, the years when it feels like nothing's happening, when the narrative turns against you, when conviction is tested. That's where most give up, and that's where opportunity concentrates. Cycles are emotional as much as they are economic. They test patience, conviction, and discipline. In euphoric times, they tempt us to believe that the current pace of growth will last forever. In difficult times, they convince us that recovery is impossible. But both extremes are illusions. Long-term thinkers know that innovation never stops, it merely changes shape. They understand that periods of consolidation are not endings, but beginnings in disguise. We're at an inflection point now. Inflation, interest rates, geopolitical realignments, all of these are resetting the framework for the next growth cycle. Capital is being repriced, risk is being reevaluated, and industries are being forced to adapt. It feels uncomfortable because transformation always does. But beneath that discomfort lies a generational opportunity, the kind that only comes when old structures give way to new possibilities. Long-term cycles also demand long-term vision. The greatest investors and builders have one trait in common: they stay anchored to the future. Even when the present feels uncertain, they understand that cycles don't reward speed, they reward endurance. The compounding of innovation, of research, of belief, these are not measured in quarters but in decades. Those who plant seeds during downturns are the ones who harvest outsized returns in the next expansion. When we think long-term, we stop asking, "What will happen next month?" and start asking, "What will the world look like 10 years from now?" That shift in thinking changes everything. It changes how we allocate capital, how we build companies, how we view volatility. Instead of fearing it, we start to see it as part of the process, a signal that the system is resetting for the next leg of growth. This is how exponential change feels in real time, chaotic, uncomfortable, yet filled with potential. The ones who think in cycles, not moments, understand that the greatest risk is not short-term loss but missing long-term opportunity. Because cycles always turn. The same way winter gives way to spring, contraction gives way to expansion. What matters is how we position ourselves when that turn comes. So don't let temporary noise distract you from permanent trends. Think in decades, not days. Remember that every great innovation cycle has been underestimated in its early years and overvalued in its maturity. The key is to stay through both, to build, invest, and hold through the uncertainty until the future becomes obvious to everyone else. The next great wave of growth is forming beneath the surface. It won't be driven by speculation, but by substance, by real productivity gains, real breakthroughs, real change. And those who think long-term, who understand the rhythm of cycles, won't just survive the transition, they'll define it. Because in the end, the market rewards not the fastest, but the most patient, not those who chase trends, but those who stay aligned with progress through every turn of the cycle.